I'd like to start by just pausing for a second on an important note. It is important because obviously equity investment carries risk, and there are times, of course, that shareholders can lose money as well as make money. But we do our best to make that ride as smooth as possible. So what is Witan Investment Trust? Witan Investment Trust is an investment company listed on the London Stock Exchange. We were founded in 1909, so 140 years ago, as a home for the assets of one family. Now, obviously, 114 years on, we are listed on the stock exchange, and so investors can buy into shares in Witan Investment Trust, and we now have in excess of 20, possibly even 25,000 shareholders who we invest money on behalf of. So what is it that we do? We are a globally diversified equity investment company. We look to choose the best possible managers to manage bits of our portfolio, so that when blended together, our shareholders get a diverse portfolio of different companies that are invested in different sectors and different countries around the world. We're actively managed. That means that all of the managers that we select, of which there are currently 7 managers, manage active portfolios. In other words, they run high conviction portfolios. They select a relatively small number of companies, somewhere between 20 and 40 typically, to make up their portfolios, so that when they're blended together, Witan shareholders have a portfolio that is diversified across the investment universe. Witan is independent, and that makes us rather unique in the investment company world. We don't have a separate asset management company responsible for the management of Witan. I and my colleagues are employed directly by Witan. It means that our shareholders are in fact our employers as well. So we answer directly to them, and we only do one thing, and that is to manage Witan Investment Trust. We don't have a suite of funds that we look after. We have a board of directors, 8 independent directors. In fact, one of them is here in the room today, I can see. So I'm sure if there are any questions about corporate governance, we can address those. So anyway, 8 independent directors. They're responsible for the oversight of the company, and indeed for representing shareholders' interests. So a very important part in the investment company structure. And we have an investment team. Is our job to identify and to select with the board's approval the managers that run our portfolio on our behalf. We're often compared with a fund of funds. Now, we are similar to a fund of funds, but we're different in a number of key aspects. And that is that instead of investing into funds run by our fund managers, they have given discretion to run bits of our portfolio. And you might think that's semantics and it's not really important, but actually we believe it is important because those companies, those investments are in our custody. It means that we know exactly what our managers are doing day by day. It means that when they're buying and selling securities, it gives us information on how they're thinking about the world. Is, God forbid, one of our companies is going through a period of turbulence or trouble, and we can see immediately whether it's owned in the portfolio or whether it's not, as opposed to wait for fund reports to tell us such. And we can then go talk to the managers about the company in question. And also it helps with our oversight of our responsible investment policy and ESG, which I'll go into a bit later on. So this is how Witan is structured. We've got the board of directors who set the overall strategy, and they oversee everything that goes on. They delegate much of the day-to-day operations to us in the investment team. It's our job to identify and to oversee the managers. The portfolio managers here, of which I mentioned already, there are 7 or 8 of them actually, are responsible for the selection of the stocks in our portfolio, and they have working within those teams of analysts that are responsible for identifying those investment opportunities. So what it means is that when you buy a share of Witan, you have tens, possibly hundreds of individuals that are working day by day, looking for and identifying opportunities, as well as overseeing the stocks within their portfolio. And here's the end result. You can see that the Witan portfolio, nearly £2 billion of assets. It's about 1.8 billion today, managed by 8 external managers. There are 235 companies that are directly held in our portfolios, and they're spread across 26 countries in other sectors, many industries, and we also invest in specialist funds. I'll come onto that in a minute. We look for managers who are talented, who have a long track record of delivering good returns, managers who are sometimes adaptable to allow us to benefit from a changing investment environment, who are certainly experienced, and indeed who are independent. And that's quite important for us because we want people who are aligned with the interests of our shareholders. So just to give you an idea of what that actually means in practice, here we have some examples of companies and funds within our portfolio. The way we think about creating Witan's portfolio is really a reflection of the kinds of shareholders that we have. The majority of our shareholders are individuals. And so the way in which Witan's portfolio has been built is to best reflect their interests in investment terms. So we have a portfolio that's divided up between what we call the core portfolio and our specialist portfolio. Now, I'm sure you recognize many of the names of companies within our core portfolio. We have 6 investment managers that are responsible for building that core portfolio, 5 of whom run global investment mandates, 1 of whom has a UK investment mandate. Together, they make up about 75% of our assets, and really that's the engine room that drives Witan's performance. So you can see here, for example, and I won't go into huge detail on these, but companies such as Google, Microsoft, LVMH was in the news this week. My compliance officer tells me I'm not allowed to focus on just the winners, by the way, but LVMH was in the news this week with great results, defying many skeptics really about the valuation of that company. It is highly rated, but growth continues to come through. But as you can see, this isn't just about technology and high growth companies. We also have shares in BP, one of our largest investments at the moment, Canadian Pacific Railway, and indeed Allied Irish Bank in Ireland. So a selection of companies, different characteristics who perform differently in different environments, which go together to build a portfolio really for all weathers. Many of our largest holdings are owned by more than one of our investment managers, by the way, and that's fine by us, because one of the enemies of the fund-of-fund or multi-manager structure is over-diversification. We want to provide our shareholders with a diverse portfolio, but if it's over-diversified, you run the risk of not being able to deliver returns which are different from the benchmark. But even having said that, even if some of these companies are owned by 2 or perhaps even 3 of our managers, typically they're not very much bigger than about 2% of our portfolio. I want to focus a little bit more on the specialist portfolio, because that's really what I think differentiates what Witan offers from some of our peers. So the specialist portfolio was really built in recognition of the fact that whilst these are great companies that sit within the core portfolio, there are many investment opportunities in the world that sit outside the large and mega cap space in primarily developed markets. So the specialist portfolio is a collection of managers or funds through whom we get access to key growth themes, or indeed special situations, or undervalued opportunities from time to time, and hopefully a combination of all 3. I'm going to pick 2 or 3 out because I think they're worth talking about briefly. We have about 8% of Witan's assets invested directly in what we broadly describe as climate change solutions. One of those investments is in a fund called the GMO Global Climate Change Opportunities Fund, and that fund looks to benefit financially from efforts to mitigate or adapt to climate change around the world. So they own companies like Vestas Wind Systems, the manufacturer of wind turbines, of course, Solar Edge, who's in the name, solar power, Energy Darling Ingredients. Darling Ingredients is an interesting company. It's over 100 years old, but it's operating in what is quite a fashionable space these days, and that is the recycling of agricultural and food waste to create animal feeds, biofuels, and that sort of thing. So, interesting company that sits within the climate change portfolio. The second way of us getting exposure to the climate change theme, and we think this is a very long-running theme that's going to go on for decades ahead because of the enormous amounts of money that's going to have to be spent to mitigate and to reach the goals set by governments around the world to hit net zero. And that investment is the VH Global Sustainable Energy Opportunities Fund. It in turn invests in things like hydropower in Brazil, solar power and battery storage in Australia, carbon capture and power generation here in the UK. But it's important to know that, as an investment company, we've committed to have net zero emissions from our portfolio by 2050. The most important thing in terms of our investments is that we believe those investments are financially beneficial for our shareholders. The second area I'd like to pause on for a second here is private equity. Now, private equity's had a bit of a bad press in the last 6 to 12 months. Discounts on the listed private equity vehicles that are listed on the London Stock Exchange have widened dramatically. And any of you over here very early this morning might have heard the first presentation given on this stage at the 9:30. I'm talking about discounts across the investment trust world. Well, private equity's been at the forefront of this. Indeed, we were able to buy into a vehicle at 50% discount to asset value the other day. In total, so we've got the one I've highlighted here is ADAC Partners. We've got two other investments. Together, they have a stock market valuation of £90 million. That's the value of our investment in them. But net asset value of those investments is £140 million. So 36% discount to asset value. That means that if the discount closes over time, we stand to benefit from the gain, irrespective of whether the NAV performs well or not. Our assumption is that net asset values might decline a little bit, but there's a huge margin of safety in that big discount that we're able to buy these vehicles. Another area that the specialist portfolio focuses on is life sciences and biotechnology. Again, we believe this is a long-term growth theme. It's an area where many of our core managers won't tread in investment terms because it's highly specialized. The company I've identified here is Syncona, but we have two other investments as well. Syncona is a British business that is spun out of the Witan Trust. The Witan Trust, of course, is heavily involved in the development of novel drugs and treatments in the UK. Syncona, what they do is they identify leading science and then build businesses around potential cures for unmet clinical needs. We've been invested in Syncona for a while. It's run by a chap called Martin Murphy, who's not only a wonderful clinical mind, but he's also a great investor. So again, those are the sorts of investments that sit within our specialist portfolio, which we think adds an additional dimension to what it is that Witan is able to offer to our shareholders, and that is a one-stop shop for global equity investment. Now, it would be remiss of me to say or to not mention that none of this is a recommendation to buy or sell any of these individual companies. These are purely there for to illustrate Witan's portfolio. And what I can do is give you a tip, because it's Grand National this afternoon. Grand National, I think, starts at 5:15, so any of us that are able to get home in time to watch the off, hopefully we can stop at the bookies on the way. And I identified a course called Carefully Selected. Now, unfortunately, it doesn't look like the bookies agree with me, because the last time I looked, the was 66-1, so maybe it's a lead-to-way bet. But the reason for me mentioning Carefully Selected is it's what we do. is what Witan does. We carefully select our managers, and we put them together, and they carefully select the portfolios that are managed on our behalf. So what I thought I'd do at this stage is try and bring our portfolio to life a bit, or bring our manager lineup to life a bit, to introduce you to the individuals that are making the individual stock selection decisions. So first of all, Jennison Associates. These are in alphabetical order, by the way, no order of preference, except we appear to ignore any asset manager in the world whose name starts with anything before J in the alphabet. But anyway, Jennison Associates, based in Boston. This is what Barry Bell. Mark identifies high quality growth businesses. He owns LVMH. They look for companies with positively affecting growth rates. So these are companies that are really going through the peak of their growth potential. We blend those with other managers. Here you can see Pete Davis. Lansdowne Partners are based in London. They've got a long track record of making investments across the world, but they have a particular expertise in developed markets, primarily the US and the UK. And quite a lot of their assets are invested in the UK at the moment, which for people who have their own portfolios invested in UK assets, I'm not sure what that tells you, but it tells you that people who are able to fish across the world for investment ideas seem to be enlightening old companies in the UK as potentially that are good sources or recipients for their capital. So that's Lansdowne Partners. They're very adaptable. So at times they can own companies such as Alphabet or Nike, or there's great growth companies in the States, and at other points they might own banks or airlines or commodity businesses based elsewhere in the world. Now the face you might not recognise, this is Michael Lindsell. Nick Train is obviously much better known of the two than from Trade Partners, but Michael Lindsell and Nick Train work together to run one of our global equity portfolios. I'm sure you all know Lindsell Train. They identify good quality businesses that can generate recurring earnings over time. Next one, Andy Headley, Veritas Asset Management, another manager who looks for high quality companies, but they have quite a close eye on the valuation they're prepared to pay for those businesses. Our final global manager, WCM Investment Management. They're based just outside Los Angeles in California. Mike Trigg here is one of the portfolio managers on the strategy. And they sit somewhere between Veritas, Lindsell Train and Jennison. So kind of quality businesses, fast growing businesses, but primarily they look at two key factors when identifying a company. They look at corporate culture, which is quite difficult to analyze quantitatively, but they analyze it qualitatively, and over time they've worked out that companies that they identify as having good corporate cultures tend to generate better returns for shareholders. And they look for companies with an expanding moat. Now, the moat is a bit of a Warren Buffett terminology, a defensive position in a market, but it's not good enough in their view to have a defensive position. Your defensive position has to be growing to continue to beat off competition. So that's why we particularly liked that manager. Together, those five managers run about 65% of our assets. We then have our Simmons fund managers. Derek Stewart heads a UK portfolio identifying recovery and special situations in the UK market. I mentioned that we didn't have any managers beginning with before the letter J, but there you go, the Smiths. None of the global managers before the letter J. GMO, they run the climate change strategy for us. This is Lucas White, the portfolio manager. We worked quite closely with Jeremy Grantham, and I'm sure that Jeremy needs no introduction to many people who follow the financial press. A well-known value investor. This portfolio is now over 6% of our assets and has contributed nicely to returns over time. Our final external manager is Rajiv Jain. He runs about 5% of our assets invested in emerging market companies. He's a highly adaptable manager. And so obviously the risks in emerging markets are not just about the companies you own. Sometimes they can be political risks, as we saw this time last year. In fact, I was going to say in this very spot, it's actually over there, but this time last year, of course, when Russia invaded Ukraine. So there can quite often be negative impacts of investing in emerging markets, and they try very hard to try to avoid those. And if they're able to foresee those sort of political issues coming, they'll take evasive action very quickly. And finally, Andrew Bell, Chief Executive of Witan, and I are responsible for overseeing the group of all the managers, but not just that, we're also responsible for selecting some of the names that I mentioned earlier. So the private equity investments, some of the life sciences, biotechnology investments, as well as occasionally things like property when property is trading at a significant discount to its intrinsic value. So that brings us on to, when you put it all together, this is what Witan's portfolio looks like in terms of geographic and sectoral breakdown. North America is the lion's share, about 40%, a little bit over 20% in Europe, a little bit about 20% in the United Kingdom, which, by the way, is significantly greater than the UK's representation in the global equity market, which is low single digits. Our own benchmark actually is about 18% UK, so we are slightly higher than that, and then that's answering no other companies of countries around the world, and a broad spread of sectors. Now, I'm a Chelsea fan for my sins, so I'm actually missing kickoff for Brighton at the home in an hour's time. But I was listening to a report from the match report from the Chelsea game against Real Madrid the other day, and I heard a great analogy which I thought is quite apt for what it is that we do. And the commentator said that the problem with Chelsea is they've spent a huge amount of money on players, but it's a bit like a chef that's got no idea what he's doing. They open the fridge, take all the contents out, throw it in a pot, pouring it up, and of course it all tastes rubbish because they have thought about the way that the ingredients are put together. This is very much how we think of that Witan is. It's our job to look at the ingredients in front of us, or indeed the squad that we have, to put them together so that we have not only talented individuals, but individuals, when we blend them together, who work together as a team to generate superior returns for our shareholders. So, Witan's portfolio, that's the key driver of returns. How long have I got? Not very long. I might. Okay, I'm going to race through this then. What we've got is other levers that we can call to help deliver for the shareholders. As an investment trust, we can employ gearing. We borrow money for very long-dated fixed-rate money going out to 2054 at an average of 3%, or obviously with interest rates above 3%, that's very advantageous for us to be able to invest in the market. But obviously, as the chart here shows you, that gearing is not a one-way street. Sometimes it can exaggerate losses as well as their gains, but over the long run, it has been very beneficial to shareholders. We do buy our shares back when they're on discount. So not only are we investing in investment companies that trade at a discount to asset value, our own shares, unfortunately, at the moment are on a 10% discount to asset value, which is not the way we want to see them. But we think it's a great entry price for investors to get exposure to Witan's portfolio. And so we're happy to buy our shares back because the uplift that we get helps generate returns for remaining shareholders. And in fact, last year, our share buyback activity pretty much offset all the costs of running with it. And then finally, we can use, if the portfolio activity is the end result of our manager stock selection, we can alter that asset allocation if we think that it needs to be done. And I'm going to pause on this final slide because dividends are important to us. We're total return investors. We want to grow people's capital over time, but we are very aware of the fact that dividends are an important part of the shareholder returns. This chart goes back to 1975, which was the last year that Witan did not increase its dividend. So for those of you who have the forms you're filling in, collecting all the information about exhibitors today, I think they're asked a question about for how many years has Witan increased his dividend? Well, the answer to your question is 48 years. 48 years of consecutive dividend growth. That means that we've turned the dividend in 1975, which I'd forgotten what it was, to 5.8p last year, which is a near 70-fold increase in the dividend over that period, an annualized growth rate of about 9%, which is significantly ahead of the FTSE All Share there, agree, and even with the uptick in inflation, the UK RPI, and I use the RPI because CPI doesn't go back far enough. But more importantly, the dividend hasn't been cut, and I know that it's the board's intention that it doesn't get cut in future either. And that is unlike general equity markets where often you do see dividend cuts coming through. It's a great advantage of the investor trust structure, but also I think it speaks to the quality of Witan's portfolio, because if you're not able to generate revenue from your portfolio, it's difficult to generate long-term dividend returns. I briefly mentioned our commitments to net zero, but we have a solid framework in place to ensure that all companies in our portfolio operate in a sustainable basis and are improving over time, and particularly towards our target of 2030, where we want companies all to be sustainable businesses. Because frankly, if you're not a sustainable business, it affects your long-term cash flows. And I will leave it at that with our purpose, which is to achieve significant growth in our investors' wealth over time.